Silver just reached $79 per ounce, a level not seen in decades. China implements export restrictions for 4 days that will fundamentally reshape global supply chains. And data suggests the largest commercial participants in silver markets have shifted from net short to potentially net long positions. These aren't three separate stories. They are interconnected forces that reveal how commodity markets actually function when paper hedging strategies collide with physical supply constraints and regulatory intervention. Understanding this convergence explains not just current price action, but what's likely to happen when institutions finish repositioning and industrial buyers face genuine procurement challenges. This matters because silver isn't just a speculative asset. It's a critical industrial input for solar panels, electric vehicles, and electronics manufacturing. When supply chains for strategic materials become constrained while financial positioning shifts, prices don't adjust gradually. They reset violently. And we may be watching that reset begin in real time. Before we discuss what's changed, we need to understand how commercial participants typically operate in commodity markets. Large banks and trading houses that handle physical silver naturally develop short exposure. If you're storing metal for miners, facilitating sales to industrial buyers, or providing financing for silver-intensive businesses, you accumulate short positions as part of normal business operations. These aren't speculative bets. They're hedges against physical inventory risk. For years, COMEX's commitment of traders' data showed substantial commercial short positions, particularly among a few large participants. This became controversial, with critics claiming manipulation. But from a risk management perspective, maintaining shorts while handling physical operations makes perfect sense. You're offsetting price risk on metal you store, process, or have forward sale commitments for. What's significant about recent data isn't that commercial shorts existed, that's standard. What's significant is that commercial net short positions have declined substantially from historical norms. We can observe this in publicly available COT reports without needing insider information. When commercial participants reduce shorts, several explanations are possible. They might have delivered physical metal against positions. They might have transferred inventory to other entities. Or, and this is where markets get interesting, they might have reassessed the risk-reward of maintaining short exposure as fundamentals changed. Institutions don't corner markets through conspiracy. They adjust positioning when their risk assessment changes. Let's examine what might drive a major commercial participant to reduce or reverse short exposure. First, inventory depletion. If you're short futures as a hedge against physical inventory, but that inventory has been steadily drawn down through sales or deliveries, your hedge becomes unbalanced. Maintaining shorts without corresponding physical metal transforms a hedge into a speculative position, exactly what risk managers want to avoid. COMEX's registered inventory has declined approximately 70% since 2020. London vaults have drawn down significantly. If your short hedge was sized for larger physical holdings, and those holdings have shrunk, prudent risk management requires reducing shorts proportionally. Second, supply constraint awareness. Banks with global commodities operations maintain sophisticated supply chain intelligence. They monitor mine production, refining capacity, industrial demand forecasts, and regulatory developments across jurisdictions. If your analysis suggests tightening physical markets, perhaps from accelerating solar and EV adoption, perhaps from anticipated regulatory changes in major producing or refining regions, the risk profile of short positions changes dramatically. A short that made sense at $25 silver with ample supply becomes increasingly dangerous at $50, $70, or higher when supply constraints emerge. Third, opportunity cost. Capital committed to maintaining short positions that are increasingly expensive to roll or defend could be deployed elsewhere. If fundamentals suggest upward price pressure is more likely than downward, reducing shorts isn't manipulation, it's rational portfolio management. China's export licensing system for silver, effective January 1st, represents the type of regulatory change that forces institutional repositioning regardless of speculative intent. The requirements are specific. Companies seeking export licenses must demonstrate an annual production capacity of at least 80 metric tons and maintain credit facilities of around $30 million. These thresholds effectively eliminate hundreds of smaller refiners and traders from the export market. This isn't subtle policy. It's designed to consolidate control over refined silver exports among larger, likely state-linked entities. China processes a substantial portion of globally mined silver, even from ore sourced elsewhere. When that processing capacity becomes functionally domestic only, Western buyers face supply constraints regardless of global mine output. For banks monitoring this policy, development and sophisticated institutions monitor regulatory changes in major commodities markets closely. The implications for risk management are clear. If Chinese refined silver exports decline significantly, Western physical markets tighten, creating potential for rapid price appreciation. The rational response isn't to maintain large short positions into this tightening. It's to reduce or eliminate shorts before the policy takes effect. Some institutions might even establish long positions if they believe the supply disruption will be severe and sustained. Current price levels reflect markets attempting to discount future conditions rather than current abundance. At $79, silver trades at levels that historically appear during crisis or extreme shortage conditions. We're not in a traditional crisis. Industrial production continues. Markets function. Yet prices have appreciated rapidly from levels around $25 just a few years ago. This suggests markets are pricing in anticipated supply constraints rather than current shortages. The Chinese export restrictions haven't fully taken effect yet. Solar and EV production, while growing, hasn't yet consumed the quantities projected for 2026 to 2027. My supply hasn't collapsed. What has changed is positioning and expectations. When commercial participants reduce shorts, they remove selling pressure that previously capped rallies. When industrial buyers begin questioning supply security, they shift from just-in-time procurement to strategic stockpiling. When speculative participants observe these shifts, they front-run anticipated demand. Prices can rise substantially on expectation alone, before physical constraints manifest fully. But this creates vulnerability. If anticipated shortages don't materialize, or if substitution accelerates, or if demand slows unexpectedly, prices could correct sharply. The narrative around industrial silver demand deserves careful examination because exaggeration serves no one. Solar panel manufacturing does require silver paste for conductivity. Current generation panels use roughly 10-20 grams of silver per panel. At scale, this creates substantial demand. Industry estimates suggest solar consumed around 150-180 million ounces in 2024. But this isn't fixed. Panel manufacturers have strong incentives to reduce silver content as prices rise. Research into thinner paste applications, alternative conductor patterns, and copper-based substitutes continues. Some newer panel designs already use 30-40% less silver than previous generations. Electric vehicles similarly use silver in battery management systems, control modules, and various electrical contacts. A typical EV might contain 20 to 30 grams of silver, more than internal combustion vehicles, but still a relatively small portion of total vehicle cost. At current prices, silver represents roughly 0.3% of a $50,000 EV's manufacturing cost. Even if silver doubled to $150, the vehicle cost increases by perhaps $300, $500. That's absorbable through slight price increases or margin compression. The critical question isn't whether industrial demand exists. It clearly does. The question is price elasticity. At what price point do manufacturers accelerate substitution efforts? At what price does solar panel economics change enough to slow installation rates? Silver presents unique supply response challenges compared to most commodities. Approximately 70% of silver production comes as a byproduct of base metal mining, copper, lead, and zinc. Primary silver mines exist but are less common. This means silver supply doesn't respond directly to silver prices alone. If copper prices are weak, copper mines may reduce production even if silver prices are high, because copper generates the majority of revenue. Conversely, if copper demand is strong, silver byproduct supply increases regardless of silver price levels. New mine development requires 7 to 10 years from discovery through permitting to production. Price signals today don't translate to meaningful new supply until potentially the 2030s. And with most easy-to-access deposits already in production, new projects face higher costs and lower grades. Recycling provides some supply flexibility, but silver recycling rates remain relatively low, perhaps 15-20% of annual demand. Silver's industrial applications often result in dispersed, hard-to-recover uses. Extracting silver from installed solar panels or electronics waste is technically possible, but economically marginal at current prices. This supply inelasticity means short-term price increases don't automatically generate offsetting supply. The market must ration demand through higher prices rather than incentivizing immediate production increases. The Federal Reserve's provision of $17 billion in repo facility access, S coinciding with commodity price movements, TS suggests genuine stress in specific areas of the financial system. Repo markets function as banking system plumbing, where institutions borrow short-term against collateral to meet daily liquidity needs. Normally, this operates invisibly. When the Fed needs to inject substantial liquidity, it indicates strain somewhere. We cannot definitively attribute this to silver markets without Fed disclosure. But the timing, coinciding with elevated COMEX delivery demands and rapid price appreciation, creates a reasonable inference that commodity positions may be contributing to liquidity pressure. The mechanism would work as follows. A bank with substantial short futures positions faces margin calls as prices rise rapidly. Simultaneously, if holders are demanding physical delivery, The bank must source metal, which requires cash to purchase or pay premiums. Both activities drain liquidity rapidly. The Fed's response prevents this stress from cascading into broader money markets. But it also reveals system fragility. If commodity price movements in a relatively small market like silver can create liquidity stress requiring central bank intervention, it suggests deeper structural issues around rehypothecation, leverage, and collateral quality. If major commercial participants have indeed shifted from net short to net long, and we must acknowledge this, remains partially inferential from public data, it changes market dynamics significantly. Institutions that were previously sellers, covering shorts, become potential buyers, establishing or adding to longs. This removes a traditional source of supply that capped previous rallies. Markets that once hit resistance at $30 or $50 find those ceilings absent. But institutional longs don't automatically mean runaway prices. Large holders face different constraints. Liquidity risk, attempting to sell large positions, moves markets against you. A 50 million ounce position might be profitable on paper, but realizing that profit requires finding buyers without crashing the price. Opportunity cost. Capital deployed in commodity positions can't be used elsewhere. If more attractive opportunities emerge, institutions may liquidate even profitable commodity holdings. Regulatory risk. Accumulating positions large enough to potentially influence prices invites regulatory scrutiny. No institution wants to be the next Hunt Brothers facing government intervention. Financing costs. Holding physical metal or rolling futures positions forward incurs costs. These erode returns over time unless prices continue to appreciate. The existence of large, long positions doesn't guarantee sustained high prices. It means positioning has changed from a probable source of selling pressure to a potential source of buying pressure, or at minimum, the absence of selling pressure that previously capped rallies. When we strip away speculation about bank conspiracies, we're left with a genuine industrial procurement challenge that deserves serious analysis. Western manufacturers requiring silver for production now face reduced Chinese supply starting January the 1st due to export restrictions. Even if metal exists globally, if it's processed in China and can't leave, it's unavailable to Western buyers regardless of price. Depleted inventory buffers in COMEX and London vaults. The traditional cushion that allowed spot purchases has shrunk substantially. Increased competition as other industrial buyers recognize supply constraints and begin stockpiling rather than relying on just-in-time delivery. Premium expansion, where physical metal trades at significant spreads over paper prices, indicating genuine procurement difficulty rather than speculative positioning. This creates a buyer's paradox. Prices are already elevated, yet not buying means risking production disruption. So buyers purchase at high prices, which pushes prices higher, which makes other buyers more anxious about securing supply. The solution involves either price rising enough to destroy marginal demand, some projects become uneconomic, or supply increasing, which takes years, or successful substitution, which requires R&D time and production line changes. None of these resolves quickly, which suggests that elevated prices may persist longer than typical speculative rallies because industrial need creates a demand floor that speculation alone doesn't provide. Let's construct probability-weighted scenarios based on actual supply-demand mechanics rather than conspiracy theories or moonshot predictions. Scenario 1. Sustained elevated plateau at 60% probability. Prices stabilize between $70, $90 for extended periods as industrial buyers secure supply at these levels. Speculative volatility creates swings, but industrial demand prevents sustained drops below $70. Supply gradually responds through increased recycling and some substitution, but not enough to push prices back to the previous $20, $30 range. The new equilibrium reflects genuine supply constraints and elevated industrial demand. Scenario 2, further appreciation to $100, 120, 25% probability. Chinese export restrictions prove more severe than anticipated. Industrial stockpiling intensifies. Speculative momentum builds on genuine supply concerns. Prices push toward $100, $120 before industrial demand destruction and serious substitution efforts moderate increases. This level triggers a meaningful economic response. Mine development accelerates, recycling becomes more profitable, and panel manufacturers redesign for lower silver content. Scenario 3, sharp correction to $50, 60, 15% probability. Anticipated shortages fail to materialize. Chinese policy relaxes faster than expected. Economic slowdown reduces solar EV production. Speculative longs liquidate simultaneously. Price corrects sharply but stabilizes higher than pre-rally levels because some fundamental demand increase is real. This scenario requires a specific catalyst: policy change, recession, or technological breakthrough in substitution. These aren't predictions. They're probability assessments based on observable factors. Actual outcomes depend on variables we cannot fully predict: Chinese policy evolution, technological development, economic growth rates, and whether industrial buyers successfully adapt supply chains. One aspect deserves particular attention because it affects how quickly prices might adjust: the relationship between paper and physical markets. Futures markets typically dominate price discovery because they offer leverage, liquidity, and ease of execution. Most participants trade contracts, not metal. This works efficiently when physical supply adequately backs paper trading, and delivery demands remain modest. Stress appears when delivery demands increase while the physical inventory available to satisfy those demands declines. We are observing elevated delivery notices, roughly 64 million ounces demanded for December delivery in what's typically a quiet month. This represents approximately 8% of annual global mine production demanded from exchange inventory in a single month. If this pattern persists or intensifies, exchanges face uncomfortable choices: allow delivery failures, which destroy credibility and invalidate the futures contract as a reliable hedging mechanism. Markets would shift to physical-only trading with massive liquidity reduction. Allow prices to rise until delivery demands moderate, as buyers decide that cash settlement at higher prices is preferable to demanding physical at those prices. Implement position limits or force liquidation, which creates regulatory concerns about market manipulation and government intervention. The second option, prices rising to discourage deliveries, seems most probable, but this means paper prices are converging upward toward physical market levels rather than physical prices falling to meet paper markets. We're potentially watching this convergence process. Shanghai physical premiums over COMEX futures indicate physical scarcity. As long as those premiums persist and widen, they create upward pressure on futures prices as the market tries to find equilibrium. The Federal Reserve's repo facility provision matters less for the specific dollar amount than for what it reveals about system stress and probable policy response. When commodity price movements, in relatively small markets compared to equities or fixed income, create liquidity stress requiring central bank intervention, it demonstrates how interconnected and leveraged modern financial markets have become. Banks aren't just trading commodities. They're using commodity positions as collateral for other transactions, hedging those positions with derivatives, financing inventory with short-term debt, and operating within complex risk frameworks where moves in one asset class can trigger margin calls in others. The Fed's response establishes a precedent. Commodity-related stress will not be allowed to cascade into broader financial disruption. This implicit backstop actually supports commodity prices rather than containing them, because it assures market participants that systemic risk from commodity squeezes will be managed through liquidity provision. From a game theory perspective, this creates asymmetric incentives. If you hold physical commodities and prices rise, you profit. If prices crash and threaten system stability, the Fed provides liquidity that may limit downside. This isn't a Fed put under commodity prices exactly, but it does reduce tail risk from the holder's perspective. We need an honest assessment of substitution possibilities, because this determines long-term price sustainability. Solar panels, copper pastes can replace silver in some applications, but with efficiency losses currently around 0.51%. For utility-scale solar, where efficiency directly impacts returns, this matters significantly. Residential installations may more readily accept efficiency trade-offs if silver costs escalate substantially. Research into silver-free contact designs continues, but most alternatives remain in development or early commercialization. Retrofitting existing production lines requires capital investment that manufacturers avoid unless silver prices sustainably exceed pain thresholds, likely around $100 to $150. Electric vehicles. Some silver applications in EVs are substitutable with copper or gold-plated alternatives. High reliability connections in certain control systems still require silver's superior conductivity and corrosion resistance. But at 20 to 30 grams per vehicle, even complete elimination wouldn't dramatically impact total industrial demand, given solar's much larger consumption. The timeline matters critically. Even if substitutes exist technically, implementing them across the industry requires 2 to 3 years minimum for testing, certification, production line modifications, and supply chain adjustments. Price pressures today don't translate to demand destruction tomorrow. There's a substantial lag. This lag period means prices can remain elevated even if substitution is ultimately successful, because industrial buyers must continue purchasing at high prices during the transition period. China's export restrictions represent resource nationalism applied to a strategic commodity. This has precedent. They've employed similar approaches with rare earths, tungsten, and other materials where they hold processing dominance. The strategic calculation appears straightforward. China is building massive solar and EV manufacturing capacity. These industries are silver intensive. Ensuring domestic supply priority while potentially creating supply constraints for Western competitors offers dual advantages, supporting their industrial policy while potentially hindering competing industrial bases. This isn't a conspiratorial partnership with Western banks. It's a rational pursuit of national economic interests. But the effect is similar. Reduced supply available to Western markets regardless of price. Western policy responses might include developing domestic refining capacity requires capital investment, permitting, and years of development, not a near-term solution. Negotiating bilateral agreements with other producing nations to secure supply, but most major producers already have relationships with Chinese refiners. Strategic stockpiling at the government level, similar to petroleum strategic reserves. Some discussion of this exists, but no major implementation yet. Accelerating substitution research through subsidies or regulatory requirements. Most direct policy options, but with uncertain outcomes and long implementation timelines. The geopolitical dimension adds persistence to supply constraints, because policy changes more slowly than market conditions. Even if prices incentivize new Western refining capacity, the development timeline extends years. During that period, reduced Chinese exports remain the reality Western buyers must navigate. Let's address the institutional positioning question with appropriate nuance. Claims that specific banks hold 750 million-ounce positions remain unverified. Bank vault inventories aren't publicly reported. We can observe declining COMEX commercial net shorts in public QOT data, reduced registered inventory, suggesting physical deliveries against short positions, elevated delivery demands indicating preference for physical settlement, premium expansions suggesting physical scarcity relative to paper. These observations support a thesis that major commercial participants have reduced or potentially reversed short positions. Whether this represents a deliberate accumulation strategy or prudent risk management in response to changing fundamentals is interpretive. The more defensible argument, institutions with silver-related business naturally developed short exposure as hedging. As fundamentals tightened, inventory declined, industrial demand grew, and regulatory changes loomed, maintaining large shorts became increasingly risky. Reducing or closing those positions is rational risk management, not market manipulation. Some institutions might have gone further, establishing long positions based on supply-demand analysis. This would be speculative positioning, but within the normal bounds of commodity trading. The line between legitimate position-taking and market manipulation involves size, intent, and behavior, areas where we lack definitive public information. What matters more than motive is effect. A major reduction in commercial short positions removes significant selling pressure that historically capped rallies. Combined with genuine supply constraints and elevated industrial demand, this creates conditions for sustained higher prices regardless of whether anyone intended to corner the market. What we are witnessing appears to be a fundamental transition in how silver markets function, from paper-dominated price discovery to physical constrained pricing. For decades, futures markets efficiently set prices because physical supply adequately backed paper trading. Delivery demands remained low because participants trusted access to physical when needed. This allowed leverage, liquidity, and efficient hedging. That system becomes stressed when physical inventory supporting paper trading has depleted significantly. Delivery demands increase as trust in paper settlement erodes. Geographic restrictions prevent arbitrage that normally aligns prices. Industrial buyers shift from just-in-time to strategic procurement. These conditions now exist simultaneously. The result isn't necessarily conspiracy or manipulation. It's market structure adapting to fundamentally changed conditions. The convergence of reduced commercial shorts, Chinese export restrictions, depleted inventory, and elevated industrial demand creates conditions for sustained higher prices. Not because anyone controls the market, but because multiple independent forces point in the same direction. For industrial buyers, this means procurement challenges persist until either supply increases meaningfully, years away, substitution succeeds, also years away, or demand destruction occurs, requires substantially higher prices. For financial participants, this means volatility continues as markets find a new equilibrium between paper mechanisms and physical constraints. For observers, this means watching how markets evolve when paper abstractions confront physical reality, a transition that rarely proceeds smoothly but eventually resolves toward prices that reflect actual supply availability rather than derivative leverage. The institutional pivot, Chinese policy changes, and price appreciation to $79 aren't separate events. They are connected responses to the same underlying reality. Decades of consumption exceeding mine supply have depleted buffers, just as industrial demand accelerates. The next phase involves determining how high prices must rise to balance supply and demand when traditional mechanisms for achieving that balance have become constrained. That's the story unfolding, not a conspiracy, not manipulation. Just markets adjusting, painfully, expensively, to changed conditions when physical scarcity meets financial positioning that assumed continued abundance.